Um, Great. Let's begin. So in this session, we're going to have a panel discussion. The title of the discussion is Digitalization Across Generations, Evolution or Another Revolution. And the overarching question is, are we, maybe we can kind of figure this out together in the next approximately 45 minutes. Are we at a turning point in financial market history, or is what we're seeing right now really just another step of technological innovation? So that just another, maybe another revolution or another evolutionary step. I would first like to welcome my speakers again. So right next to me is Andrei Kirilenko, whom you have seen yesterday, expert on regulation of fintech, you could say. Next to this is Pete Kyle, whose talk on microstructure you have heard yesterday, and from whom we have received some very interesting insight about the future of fintech. And then I have to consult my little cheat sheet. Next to this is a new speaker, whom you have not seen yet, who's going to talk in the last session, Claudio Sassone. Claudio Sassone is an assistant professor in network science at the University of Zurich. He has a PhD in physics from the University of the Balearic Islands in Spain. His research primarily focuses on diffusion and spreading on socio-economic and social-technical systems. And another focus of his research are blockchain and cryptocurrencies, with a particular focus on hidden incentive schemes that are created by these mechanisms. And the final speaker is my fellow co-organizer, Vladimir Petrov. Vladimir holds a master's in physics, a PhD in finance from Zurich University, which he has received just this year. And he's working together with Like Corp on, I would say, the future of the platform. Is this how you can say it? Yeah, great. So the idea of the panel is that we together as speakers from these diverse backgrounds would kind of try to approach the question, is it an evolution or another revolution? And so the idea would be that for the next maybe 20, 25 minutes, I would ask some questions, and then I would like to open for questions from the audience. I would like to begin with the topic we saw this morning, which is algorithmic trading. And I want to show a picture, which is a chart of the 2010 flash crash, where within very few minutes, the S&P 500 and other indices lost a very large amount of value. So this stock market crashes happened very quickly. I want to ask a question to Pete and Andrei. You have written a paper together on this flash crash. Perhaps you could describe quickly what your insight was from that paper, what was happening during that flash crash. Maybe.
I'll start. Yeah. So let me start telling you a bit of a story how the paper came about. So in 2008, after when the global financial crisis was going on, I joined the U.S. government, the Commodity Futures Trading Commission. And one of my, can you hear me okay in the back? Sorry about the voice. And one of the roles that I started working on, among other things, was to create and prototype automated surveillance systems. So surveillance modules for automated markets. So no U.S. federal regulator at the time had anything like that. So markets have automated, but the surveillance protocols were still based on humans. And I started putting together a team of people and looked around. And Pete was just next door at the University of Maryland. So I obviously knew about him, about his pioneering work on market microstructure. And so I got in touch. Pete was very kind to come over, and we started talking. And as we were talking, Pete said, why don't we write a paper, just like a descriptive paper, 1 day in the life of the automated markets? Because, to write a paper, it's, it's good to organize our thoughts that way. Remember that, Pete? It's good to organize our thoughts that way. And, and I'm like, look, I have a lot of things to do. So if we're going to write a paper, I could contribute like a research assistant, and can you give us anyone? And so Peter's like, I have this talented student. So we had, the four of us just sort of sat down and started looking into writing a paper. One day in the life of automated markets. It was the, I would say, summer of 2008. And it took us, I would say about 6 to 12 months to understand the data that we were dealing with, transaction level data. And again, the reason we decided to, we were like, so which automated market? And we're like, look, if we want to publish in a finance journal, I mean, we can do crude oil or gold or whatever, but why don't we do the E-mini futures? Because, it's a stock index futures contract, fine. So we decided on that. Started pulling in the data, transactions level data, didn't look into the order book. It looked like we were like the first people in the agency looking at this data. Like, we were asking these questions and people are like, no one has ever asked us these questions before, so here. So the agency collects the data, unlike the SEC. SEC does not have the data. FINRA collects the data, not the SEC. So we started looking at it and started building up some modules, just basic things, inventory. Inventory is just sort of counting, buys versus sells on a particular day for each trader. So on any given day, you have about, at the time, there was about 1 million transactions, 100 million orders, and I would say probably more messages, and it's something on the order of 25,000 what's called trading accounts, market participants. You can go deeper, you can go higher, you can go all the way to the algo level, or you can get at the level of trading accounts. So trading accounts is at the level at which you post a margin. So you can aggregate multiple accounts and multiple algos into a trading account. So we decided that represents, trading account level represents sort of risk, because if you post margin at that level, that's how much risk you post to the clearinghouse. And whatever you do during the day translates into like what ends up. So we were building these modules and, basically piecemeal approach, looked at some of the network technology to look at it, did some bean counting in terms of inventory. And so we had a bunch of modules. Again, this is all part of a, we are working on it as an exercise because it makes sense, for academics and practitioners to work on it, approach it as a paper. But, the idea that it's we're also working on something, building up these modules. And then on May 6, 2010, that happened. And that was a Thursday. On Friday, we received the data that we've been working for 18 months prior. And on Saturday, I asked everyone to come to the office. And then we sit down, and Peter's like, why don't we write about this day in automated markets?
Yeah, so I remember it pretty much the same way Andre explained it, although I called the project One Day in the Life of a High-Frequency Trader. And so I was technically a contractor, I think, to the CFTC. And my thinking about the project was, even though no one was interested in high-frequency trading in 2008 or 2009, Andre and I both thought something's going to happen that's going to get people interested in this. And so the CFTC might be well advised to understand how high-frequency trading works before it becomes something at the top of the agenda. But as it turned out, if you look at the picture behind me, and you see what happened during the flash crash, what came out of our analysis is that the high-frequency traders, for the most part, just ran their algorithms the way their algorithms run, buying and selling and buying and selling and buying and selling. They actually kind of got run over at the beginning of the flash crash and wound up buying a lot. So they took a fairly large long position compared to what they usually take in the first stages of the flash crash. And they held on to that down to the bottom. So they lost a lot of money compared to what they usually make or lose. But as you got to the very, very bottom of the flash crash, in the last few seconds before it hit the very bottom, the high-frequency traders were all trying to both buy and sell But since they had inventories that were kind of large, they were kind of maxed out in some sense on the alongside of their inventories. They were anxious to sell, and so they were exploring for a price at which someone would be willing to buy. And so there was this kind of flurry of sell orders in the last couple of seconds that pushed the price down to the very bottom. And then the CME had a 5-second trading halt because there was such a big gap in prices, and prices subsequently rebounded. What we found was there was one trader who sold 75,000 contracts, which is $4 billion worth, and they did it over a very short period of time, maybe 15 minutes or something like that. And that's a very large quantity to sell over such a short period of time. There wasn't. At the end of the day. Yeah, and then it was kind of in the afternoon, sort of towards the end of the day. And we thought that it was this rapid selling by this very large trader that is what actually caused the flash crash. And by contrast, the high-frequency traders might all added together at any one time own 5,000 contracts. That would, I think, 5,000 more than they ever all owned together at one time. So you can see that their entire aggregate behavior of all the high-frequency traders combined was not nearly enough to provide the to take the other side of a $75,000 sell order. So even though they kind of did what they were supposed to by buying, they just got run over by the large quantity, and then the ultimate liquidity was supplied by other people that came in and took the other side of it. But the percentage of their share of the volume, it was maybe a little bit different from normal, but not that different from normal.
Yeah, the interesting thing that happened is there was, as you can see, it reversed, right? And on this chart, you just sort of see it just sort of goes down and then up. Question is why? How did it, why at that level, what happened? What happens in the very, very bottom is that, I should also tell you that the various mechanisms that were put in place after the 1987 crash that Pete also worked on were not triggered. So for a variety of reasons, they were not triggered. But one thing that got triggered is this literally several lines of code. So exchanges are automated, CME is automated. This contract is entirely electronically traded. There are no humans, there's never any floor, right? So it's all algos all the time trading that. And and so at the CME, they put in a bunch of these different hacks, basically, to prevent markets from being rattled. Typically, these hacks were triggered during the off hours when the liquidity is low and there are holes in the book. And this particular one, out of many, this is not the only one. It's out of sort of a whole bunch of them. They're called pre-trade safeguards, meaning that you can submit and cancel and modify your orders, but the matching engine is not going to match trades, right? So it's all pre-trade. This particular one got triggered. It's a 5-second pause. So 5 seconds, like 1, 2, 3, 4, 5. So for any human, any risk manager, anybody else, it's not sufficient to really do anything, to reprogram anything, to push anything whatsoever. But it made us think about, you see that at that time, prices stabilize, and then they shoot up. And so the subsequent work that Pete sort of took in one direction, and I took in a bit of a different direction, had to do with time. And with time and sort of the scales of time, because it's very, very, it's evident, and that's where we connect, is that the systems have become almost physical, right? So their algorithms are very, very precise lines of code. They follow a certain architecture. So this almost laws of physics are now becoming sort of manifesting themselves there. And again, just like in physics, you have laws of physics that have to do with sort of large quantities. You can call it, Newtonian mechanics. And you have laws of physics that are more like quantum mechanics that have to do with small amounts but at very high speeds, right? And so when they come together, that's where sort of a large object amplified by something that moves at sort of high speed, moving trades around, create systemic events of this nature. But time, this 5-second pause, did something. And so the question was, what did it do? And how do computers perceive time? What does time mean to them? One hypothesis, it's unconfirmed, But one hypothesis is that after the 5-second pause, the exchange, the CME in particular, goes into, basically sends a flag to all the algos out there and says it's a new day. It restarts the day. So algos don't know when one day ends, when another day starts. They need to receive that information. So what do the algos do when they get a flag, it's a new day? They all recalculate their inventory. They all look and calculate historical price movements, and then they make decisions whether or not they go into submit orders to buy or not. A bunch of algos looked at it and said, well, it's a 3 sigma volatility event, probability of which is pretty much 0. Prices are going down, and prices with 90% probability in these markets mean revert. What do I do? Buy. You see a lot of buy orders after that from this reset. Again, it's unconfirmed, and the scales of it are interesting. But Pete has taken it in a very interesting direction in terms of just sort of what the scales are, the invariance of scales, and so forth. But I'm getting into your territory a bit.
I wanted to, you made a very interesting connection to physics, which I believe connects very well to Claudio's topic. So Claudio, your work is in complex socioeconomic systems. If you're thinking about this, I think what we have heard from the two of you of the system of interacting algorithmic agents, is this the kind of behavior we should expect?
I think that here we have seen, it was a very interesting hearing once again this story about how this flash crash occurred. And an important thing there is that, in general, what I would argue from a complex systems point of view, and also pretty much in line to what was said before, that a simplified picture of reality, a simplified version, even a statistical version of what the agents are doing, which are the main typologies of trading strategies, would be enough to describe the agents. But I would argue that this stands much more true for during a short term cognitive agents like humans. Algorithmics are much more in some way rigid, but at the same time sophisticated than human interventions or the way in which we accumulate information. Therefore, what I would argue is that simplified models would only work in periods of basically market stability in which volatility is low, because then you can always come back to just a small family of trading strategies, and then you have a statistical view of this thing. In this kind of setup, I would argue that this is not enough, and you have to sophisticate much more the kind of trading behavior, because this is the only way in which you have these kind of runaway solutions. Mm-hmm.
You want to pass on the mic to Vladimir? Vladimir, you've done your PhD thesis on directional change intrinsic time.
Yeah, how I like to put it, it's usually about time and space in finance. So if you take a look at this chart, on the very bottom of it, you can see hours, right, from 12 to 8 p.m. If you think about this event already in retrospect and try to get some data out of it, you might take a look at 6 p.m. and 8 p.m. and connect these two dots. You'll barely notice any decline from this point of view. So here I would like to say that the concept of time is always defined in all financial problems and always used, although the very definition is rarely given. So when we perceive this flash crash, already in retrospect, we might not notice all these important events which we actually observe while they are happening. In my research work, I've been studying them and trying to figure out whether there is any other measure which can be used in order to better describe financial systems and behavior and how time is perceived. Not from the context of physical time or calendar time, which is typically used when you have, Earth rotating around the sun, Earth rotating around its own axis, and we have days, nights, hours. But from the perspectives of the time series itself, the financial system, which has its own heartbeats when it's going up and down. If you think about this high volatility, so in other words, higher fluctuations of price back and forth means contraction of time. Other way around, if you think about something very flat, like sort of standstill, it means like the time is just expanded. In our work, which I'm proud that they did together with Richard Tolson, for example, sitting in this audience as well, we use the concept of so-called directional change intrinsic time. And I think that's a concept which has to be really taken into account while perceiving such financial crisis or such events like flash crashes. Because in this intrinsic time, it does not matter how fast the time it is propagating, is evolving. The most important, what system exhibits, how far away, down or up, the price is moving. If you think about this in traditional finance, these concepts are quite well known. They're called drawdowns and draw-ups. Just when you wait until the price goes from the very top, some local top, to the bottom by a certain percentage. And in other words, where draw up when price goes from the very bottom to up by another percentage, arbitrary one. What was very interesting that in our work developed together with also Richard, so we found out that you can perceive the whole time series like this one from the perspective of intrinsic times of draw ups and draw downs constantly following each other. And now, very interesting part, when we talk about the agent-based models and how agents operate in this market, we had the whole paper dedicated to this. We said, what if our agents in real market, they don't react to physical time, they don't trade every hour, every minute, or every day, but they trade only when something happens on this market. When our price goes up and down by a certain percentage, and this is event for these agents. We had very simple model without any intellect of these guys, of these agents, and these agents, managed to replicate all stylized properties you can find in real markets, including some deviations like fat tail distribution or statistical aggregational normality when you go to higher time spans. So I think from this point of view, you do need to always apply some new techniques, new methods, non-traditional, which were not conventional before, in order to describe such events which emerge today more and more often in the world of digitized finance.
Yeah, thanks a lot for that answer. And I would like to connect what you just said with something Pete has worked on, which is the hypothesis of market microstructure invariance. So the idea that once you look at everything in terms of business time, so in terms of the kind of how quickly the market trades, market microstructure, I'm probably saying this wrong, but more or less becomes the same across all markets. So should we, I guess the question I want to ask is this kind of crash similar to other stock market crashes in the past, if we look at it in terms of business time of algorithms?
So my research with Anna Obizhaeva on market microstructure invariance kind of addresses the issue you're talking about. And in a nutshell, what we think is that different markets have different time scales, and the time scales also are reflected in the liquidity of those markets. So in a very liquid market, and you could argue that the CME E-mini, which you see behind my back, is maybe the most liquid market of all. In very liquid markets, the time is passing very fast. And so 15 minutes is actually a reasonably long amount of time. You know, maybe it's the equivalent of a day in a market for some stock. And the speed with which markets operate is reflected in how fast traders execute large block trades, and it's also reflected in how big the large block trades are. So in the S&P 500 E-mini in the stock market, the large blocks are larger than a large block would be in an individual stock, and they're executed faster. But what we found was that this block of $4 billion worth of futures contracts was executed even faster than it should have been executed if it had been executed at a kind of normal speed for the S&P 500 E-mini. The CFTC and the SEC interviewed market participants and asked them how long should it take to execute something like this, and the market participants said a few hours. But that's many times faster than doing it in 10 or 15 minutes. So if it's 10 times faster, you would expect that it would create, the way I think about markets, 10 times as much temporary price impact. And I think that's what you're seeing when you look at the flash crash there, because that temporary price impact from executing 10 times faster than you should will be reversed as soon as you finish executing. And that actually is also what we see. But just to illustrate the timescales, if you were to, this was a kind of 1 in a million type of bet that was being executed. If you look at a 1 in a million bet in an ordinary stock, that might be Warren Buffett buying the stock over a period of months and months and months, a little bit at a time here and a little bit at a time there. Or in another stock, it might be someone executing a big block trade over several weeks. But when you compress it into something that's too short, it creates a flash crash. We've written a paper on this, and another example of such a flash crash was created by George Soros in conjunction with the 1987 crash. It wasn't the 1987 crash itself, but it was something that occurred a couple of days later. But then there are other crashes that are not what we would call flash crashes, but nevertheless are the results of very large bets being executed at a kind of normal speed of maybe several days for the S&P 500 E-mini. One example was a 1987 crash. And another example that from my mind, it's perplexing why it's not the one behind us. And this was the liquidation of Jerome Creviel's rogue trades at Societe Generale in January of 2008. He had accumulated a rogue position of 50 billion euros. And so that was kind of, that position was liquidated over a 3-day period in January of 2008, during which the Fed cut interest rates by 75 basis points. But that position was more than 10 times bigger than the position that caused the flash crash. And it did make the stock market drop 10%, according to our calculations, based on invariance. And according to what happened in the market also fell about 10%.
Shall I finish this line of thought, and then we move on to the next one? So let me tell you,
sure.
let me finish off this loop on the paper. So we've written the paper, and at the same time we were working on the on the government report on the flash crash, right? So and the paper and the government report came out at about the same time. Why did we do the paper? Because the government report comes out once, and it informs the public, and it was very, very important to inform the public as much as clearly as possible about what happened. And Pete is very instrumental in pressuring me to make sure that it is as revealing as we could. Some lawyers helped in making sure that happens. But then we wrote a paper. Why did we write a paper? Because a report is issued once, and then you just sort of public reads it, and that's it. The paper we've written, so it's subject to peer review, because no one would be able to see this data. It's highly confidential, government audit trail data. So, but we needed to make sure that whatever we found out, methodologically is sound, because everything is jointly endogenous in here. So I wrote a paper. Paper went through 5 rounds of reviews, 3 different editors, and it took about a lot of scrutiny, which is justified. In my opinion, is justified, because there is no other paper I'm aware of. This is the first market crash in the era of automated markets, right? There is no paper I'm aware of that's actually scientific paper written about events of this nature in the past, right? We have sort of interviews, but nothing based on the data. And so at one point, the paper was sort of lingering. I was collecting downloads on this SRN, and the editors were pushing back at us very, very hard. And I'm like, yeah, whatever, let it just sit. People, if we wanted to inform the public is being informed. And then Pete's student, who joined the Federal Reserve Board of Governors, was called to ask a team that had to do with the flash crash on U.S. Treasuries. So he walks into a meeting according to what he told me, and then he says, "Look, I was part of the original team that worked on the flash crash in 2010." And U.S. Treasuries is like the biggest market in the world. We had a flash crash, right? So, these things happen periodically. So that was a team that he joined, and it had New York Fed, Federal Reserve Board, SEC, CFTC. I have since left. Pete has since left you were not with the CFTC on the contract anymore. I don't think so, right? So the student, the person who was working with me was finishing up his PhD at UNC Chapel Hill. So we're all gone. So he's the only person actually left in the policy and regulatory space who could carry these ideas and our methodology into sort of a government investigation. So he walks into a meeting and he says, well, we've developed a methodology. This methodology is based on these principles. This is how we look at it. And I think we should apply it to this particular event as well. And he's told, well, but it's not a published paper. And I said, fuck it. I'm going to do whatever it takes to publish this paper in the best journal, so that it's important for policymakers. If that is what's important, to make sure that our knowledge translates into how things should be done, designed and redesigned, I'll do my part. So it ended up after 7 years in a good journal and so forth. But don't think of it, what it also made me think is that there is a very, very natural tendency. You called me an expert, sort of on fintech regulation. There's a very, very natural tendency, and you see it time and time again, for regulators to hide behind something that is less transparent. That report on the Treasury flash crash came out. I have no idea what it says. Like, I read it, I have no idea what it says. Like, it says something, and it has charts, but it's completely uninformative to me. And I'm like, how is this useful for the market participants? It's like completely not useful whatsoever. I mean, the reason we were doing this is that we wanted to be transparent, so people actually optimize their algos so their shit doesn't happen again, And because the market participants will do a much, much better job if they know what to do, right? If you're transparent about what happened. I mean, they don't want to lose money. Lots of people lost lots of money. So that's the whole story of how policy, regulatory, markets, and come together. But it is manifesting itself in the way regulators approach fintech more broadly. Less so after the crisis, but still. And as Pete mentioned yesterday, markets have become less transparent with automation, not more. There's a lot more anonymity. Stuff like that, one of the things that Pete said, stuff like that would never happen on the floor. If someone would walk onto the floor and try to sell 75,000 contracts, they will be dragged off the floor by other market participants. The dude went crazy. In anonymous markets, automated markets, you can do that. And so this has become less transparent. Regulators are saying, oh, don't ask us questions anymore because whatever. And that's sort of not better. Pete, you want to add?
I suspect we should go on.
I was actually planning to briefly talk about another topic before we open open to questions from the audience, which is not a crash but a peak. This was not the one. So this was the December 2017 Bitcoin peak, and perhaps Claudio or Vladimir, perhaps you could explain to us what happened during this huge peak in December 2017, and is this something we should expect?
Well, as it has been said repeatedly, cryptocurrencies in particular, also because of the way, there are two aspects here. On the one hand, because of the policy that they have implemented in the way in which the total supply of these assets grows, are very scarce. And in particular, in periods in which there is a lot of media attention, as I'm going to show also in my next presentation, you have an exponential takeoff in the number of users that they are having. In markets in which you have so much limited liquidity of the assets, this only leads to higher and higher exponential increase of value. Also driven by the fact that the cost of production of these new assets increases because you need more computational power in order to be able to produce the already scarce elements. And then these all are elements that add up to have very strong bubbles when you have one. Okay? I think that one very important aspect in all these cryptocurrencies and all the assets that, in many of the assets that are native to blockchain-based systems, one very important thing is that we cannot neglect the social component that they have embedded into. On the other hand, we also have to consider that let's say, I think that one thing that drives exactly to this kind of behavior as well is the lack of understanding from the general public of how these assets are created, how many are they, and how they are eventually linked to the market dynamics that you can observe. Okay.
I just want to add that from one point of view, this peak spike can be regarded as the spike caused by a huge number of clients coming to this market and getting interested in new cryptocurrencies. Because if you think about this year, there was the year when the word became very well pronounced all around, media, in government, in policy-making institutions, and academia and industry. At the same time, just adding to what you just said, Claudia, before, that if that huge number of clients goes to traditional markets these days, go to New York Stock Exchange, London Stock Exchange, and try to buy something, they will not cause that huge peak, just because the liquidity of those markets is much, much higher. Liquidity is guaranteed by such huge bodies as banks, central banks, huge individuals, and companies. To some extent, you might speak about infinite liquidity, but it's not completely true. It's always has some limits, and yet it's many, many, many times more than the liquidity of those cryptocurrency markets. The market was still immature. That was only 9 years old in 2018, right? If you think about the stock market, it has been developing for maybe almost 100 years, something like that, right? Like, if you think about 300, even more. So people a little bit older than me can confirm. And so we'll definitely see more stability from my personal perspective in the cryptocurrency markets as well. It will take some time, maybe not a year, maybe not a decade, but we'll end up with a situation when the price will be stabilized to some extent. Liquidity will be brought. Maybe not to those cryptocurrencies which we have on the market today, and which is very crucial to highlight, because even thinking about Bitcoin, that was an experiment which was never intended to be that well accepted, that widely used in the society. So now we are observing more and more cryptocurrencies and new technologies coming to the market. If you think about Ethereum blockchain, which was initially created to create smart contracts, right, substituting the features of Bitcoin blockchain. Some other blockchains as well. They always been improving in their efficiency, in the scalability. So it will definitely cause some reduction of such events, such crises, as well as increase their liquidity.
Thank you very much for this comment. What I would like to do now is, as announced, have you asked your questions to our panelists. And so I'm just going to do the same thing as we did before and hand the mic around.
Thanks, guys, for the interesting discussion. Just one question on the previous graph where the market crash. You said it was one participant, with that sold 75,000 contracts at one moment. Is that correct? That was the reason for the crash. Why would one participant sell 75,000 contracts in one go like that when he knows that he's not going to get the best price if he does this? Why would he do that?
It's impossible for us to speculate about why somebody would do that, but it wasn't a fat finger mistake. In fact, they chose to execute the order by being 9% of the volume based on an algorithm that would look back over the previous minute and try to do that. And I'm just speculating here, but it's possible that they did not realize that volume was going to multiply by a factor of 10 or more, and therefore their order was going to execute 10 times faster than they may have thought if they didn't build in to their thinking that the volume was going to increase a lot. So that picture you're looking at, or we're looking at, shows the price. But if you looked at a picture that showed the volume just shot up during the period that the order was executing. And because volume shot up, the algorithm they chose made it execute faster than it otherwise would have.
Was that player ever identified who that was?
I can't really still talk about it at length, but I could tell you what the media has written about it, but you can hear it from me. So it was a particular hedge fund from sort of Midwest America. It accumulated a large long position in U.S. equities, and it put in place a trigger to, there was a fairly volatile day, the couple of days before, and so if it would put together sort of a trigger that would trigger an algorithm to start accumulating a short position in the E-minis as a hedge against the long in the equities that they held. They had a basket of equities and they wanted to hedge it against with the E-minis. So there's nothing unusual about that. what was unusual about that is how this particular algo, which algo was chosen to automatically execute it. The automated execution algo is very, very slow moving, very, very slow moving in these markets. I mean, it's designed to be slow moving. It's designed to be not to make market impact. It was, as far as we know, there was no intent to manipulate, to disrupt, to do anything. It was just a way to that this algo was triggered at a particular point in time when the timing was poor, the way execution laid out was poor, the process was not in place to have a disruptive behavior like that affecting markets. It was just dumb. It's basically dumb.
Yeah,
And
keep in mind that you almost wouldn't see it on the picture, but the volatility during the day before the algorithm actually started was very high, and markets were down like 3% already, which is more than a 2 standard deviation move. So the quantity of bids in the market on the bid side of the market was much lower than usual because the volatility was already high on that day, and that the high volatility would make the price impact of any order of any given size greater than it would be on a normal day. Now, whether they took that into account or not, I don't know, but if they didn't take it into account, it would tend to explain why there would be a huge amount of price impact associated with execution of an order like that.
And just very briefly on the second chart, do you not think it would be more useful to the reader if that chart is displayed in logarithmic rather than actual? It tells you much more.
I guess that would have been a question to me, but maybe some of you want to answer.
I agree.
Yeah, also, things like that, especially if you looked at charts for commodities, you'll see booms and busts all the time. And so it's not unusual at all for commodities, basically any commodities over any reasonable period of time you look at it. If you think of, as actually CFTC has designated Bitcoin as a digital commodity, it has the characteristics of boom and bust. Why is it? Why do boom and bust happen in commodities? We don't have a consensus model. We have a reasonable model, but the basic idea it's a model with rational agents. I mean, and the basic idea is that for commodities, during certain periods of time, supply curve becomes vertical or nearly vertical, just like for this. It's by design nearly vertical, right? So there's only so much of that gets released. And if you have a demand shock, you have a demand curve starting riding up and down the supply curve. And basically, it could ride just as high up as the expectations allow it to ride, and then expectations flip there, and it just rides down. So demand here could drive a lot of things. However, having said that, a lot of you are aware that there's a massive inquiry into manipulation associated with Tether and Bitcoin, where that it may have nothing to do with it may be all or mostly manipulative activity, which also happens a lot.
So one point relative to that, it was pointed out yesterday that the volatility in Bitcoin was about 5 times greater than the volatility in the stock market. Keep in mind what that means. It means that things happen 25 times, 5 squared times faster in Bitcoin than in other markets. So the volatility is extremely high. And one thing that could be amplifying the volatility is that it's difficult to take short positions in cryptocurrencies, and it's also difficult for a government regulatory agent to order someone who's cornering the market, that is owning large quantities of the asset, to sell their asset into the market. Like who do you tell to sell Bitcoins, given the anonymity with the way the market works? So the inability to sell short and the inability to for a regulator to protect the public from price manipulation tends to create high volatility and spikes in prices.
Yeah, I would say that perhaps this was a good explanation before the markets of cryptocurrencies were regulated as they are nowadays. Now you have anonymity is not something that people can claim in terms of large volumes. I understand, however, that there is a large manipulation, for example, in the volumes that some of the markets claim that they have, and this creates a lot of uncertainty But at the end of the day, nowadays, I think that the most important thing with respect to volatility is simply the fact that there is not an underlying value for the price of cryptocurrencies.
Right, and from my side, I really would like to come very close to the question you just asked from the very back of this audience, saying that whether it would be better to show this chart in logarithmic scales, and just maybe to cover a little bit the aspect, showing in logarithmic scales might reveal some more information which is present on the plot, especially taking into account that there are markets which are full of so-called scaling laws. Scaling laws stating that whatever happens on the market on one scale might be pronounced on another scale like a logarithmic function. You know, relative change of one value results in relative change of another one. In case of this Bitcoin rise or Bitcoin drop again, you might see some information which would be actually linear function, these double logarithmic scales, and might very well coincide with what we observe for other markets, like stocks markets or forex ones. So yes, definitely the answer to this question is yes. It really much depends how you're going to use it. Whether you are going to still stick to those timelines which are within 1 day time interval or 1 year, or you would like to consider it as high frequency market. It really pretty much depends.
Yeah, thank you very much for these comments. I think we can take one last question. I think Richard, you wanted to ask a question.
Just eager, if each one of you had to give one recommendation to improve the quality of markets, what is the most important thing to do?
Well, since I'm usually the last one answering, so maybe I can be the first one here. In one of our works, which we did together, we revealed that the concepts of time, again, they are different in different markets. As just Pete recently said, you might have one market, let's say Euro USD, and have time flowing in one way, and then you take Bitcoin, let's say yen, and price is completely different, escalating a lot. When you apply the same concept of time to these markets at the same time, so let's say you consider both of them from the hour-by-hour perspectives, you cannot interpret results equally. You can't. It just doesn't work because the nature of time is different. The heartbeat is different. In one of the works which we did together with Richard, with you, and I'm just speaking to the audience, maybe not for you, of course, we found out that when you apply this multi-dimensional directional change intrinsic time aspects to whatever model, to the whole market, you might increase the stability of these markets because you perceive them as general, as united matter, not as separated and completely individual elements of the system, which have practically zero information to some extent. You miss so much details about what's happening and what's affecting of these markets, just omitting others. So from this perspective, I would really recommend to the audience, take a closer look at this concept, which is called directional change intrinsic time, and try to think how it can be extended to the multidimensional space.
The thing that I would say is that one thing that prevents, in particular, this kind of runaway solutions is applying friction in the market. So making not necessarily all the transactions costless. Because in this way, you have to be a much more meaningful reason to apply a transaction in such a way that you do it and you do not use it only for speculative reasons.
So my answer might be exactly the opposite, but it's introducing flow trading into the stock market, the way I described it yesterday, which is where you're trading in shares per second or shares per minute rather than in absolute quantity that you want to buy, and let the market clear that way. But more importantly, let other markets, the corporate bond market, the currency markets, the government bond markets function in a manner that's more similar to the way the stock market and the futures you see in a market is determined by the long-term traders and their willingness to buy the asset and hold it for a very long time. So I'm guessing high-frequency traders account for 0.1% of the variance of returns that we see, and that long-term traders are the ones that dominate both the level of prices and its volatility.
Thank you very much for this perfect closing round and closing remarks for this panel. Let's all thank the panelists again by giving them a big applause. Thank you very much.
And thank you, Stefan, for organizing this panel and leading it. Thank you as well.
Welcome.